Hey there, thanks for stopping by. You've stumbled upon our new student loan refinance and consolidation course. Here at LendEDU, we're committed to helping borrowers and their families navigate the intimidating student loan market. In this series, we tried to feature a variety of topics important to understanding student loan refinance and consolidation. We don't need to spend hours covering these topics. Each video is short and to the point. If you'd like more in-depth explanations of any of the topics covered in the series, head on over to the resources section at lendedu.com. Enjoy! Private student loan consolidation allows borrowers the ability to consolidate and refinance one or multiple loans into one loan at a potentially lower interest rate. Consolidating is the process of combining multiple loans into a single loan and monthly payment. Consolidation is a great tool to use if you would like to lower your monthly payment. Refinancing is the process of reducing the interest rate of an existing loan. Refinancing loans is a great option for borrowers who have good credit and would like to save in interest. Borrowers can both consolidate and refinance through private student loan consolidation. There are some borrowers who stand to gain from applying with only one private student loan because they're simply interested in refinancing. Likewise, there are borrowers who are interested in applying with multiple loans even if their interest rate does not change because they're interested in consolidating. When you first took out your student loans, you may not have been able to choose your term length. Realistically, you were given a term length of 10 to 15 years. One of the big benefits of student loan refinance and consolidation is that you get to pick a new term length. Now, depending on the lender, term lengths can range from 3 years all the way up to 25 years. For individuals looking to pay off their student loans quickly, a short-term length may be the correct choice. Shorter term lengths generally have lower interest rates, and the borrower will pay less interest over the course of the loan. For borrowers struggling to pay their monthly payment, a longer term length might be very beneficial. Longer term lengths allow borrowers to spread the repayment of their student loans over a longer period of time. The result? A lower monthly payment. That being said, you'll find yourself paying more in terms of interest over the course of the loan. Before choosing a term length, be sure to weigh all the options. Generally, shorter term lengths have lower interest rates in comparison to longer term lengths. You may have heard of the FAFSA, but unless you've actually filled it out before, you may be a bit overwhelmed. The free application of federal student aid, or FAFSA, is the form the U.S. Department of Education requires to determine your expected family contribution, EFC. The government conducts a need analysis based on financial information such as income, assets, and other family information. What's the difference between a variable interest rate and a fixed interest rate? Great question, and an important one at that. A variable interest rate student loan has an interest rate that has the potential to change over the term of the loan. Variable interest rates are calculated based off an underlying interest rate index. As market interest rates move up and down, the interest rate you pay on a variable interest rate loan can also vary. As a borrower, you're directly exposed to these changes. A fixed interest rate student loan is pretty straightforward. Over the course of the loan, you will pay the same interest rate no matter what. If you're offered a 5% interest rate for 15 years, you will pay 5% interest in every year for 15 years. In comparison to variable interest rate loans, fixed interest rate loans will generally have a higher interest rate at the time of borrowing. Getting approved for student loan refinance and consolidation may not be as easy as you think. Every private lender has unique underwriting criteria that they use to approve applications. Now, generally, applicants must be U.S. citizens, have graduated, and be creditworthy. So what is creditworthiness? Creditworthiness is an assessment of the likelihood that a borrower will default on their debt obligations. Creditworthiness is based upon factors such as history of repayment and credit score. Now beware, having a good credit score is only one factor in the equation. Many lenders also look at debt-to-income ratio as an important indicator. Your debt-to-income ratio, or DTI, is a percentage that compares your monthly debt expenses to your monthly gross income. Now, divide your monthly debt payments by your gross income per month. Your gross income does not include any tax deductions. Then, multiply that number by 100 to get your debt-to-income ratio as a percentage. If your debt-to-income ratio is higher than 40%, some lenders may be giving you dirty looks behind your back. The better your debt-to-income ratio and credit score, the lower rates you can obtain on student loan refinance loans. Before starting in on your student loan refinance or consolidation application, you need to get a few pieces of information available. Each lender has its own requirements, but generally, applicants will be asked to provide your permanent name, address, phone number, and email, your social security number, your government-issued ID such as a driver's license or passport, the name of your alma mater, and the approximate amount of your current student loan debt. After you submit the first part of your application and are conditionally approved, you'll need a couple more pieces of information to lock in your offer. Generally, you will need proof of graduation and proof of income, like recent pay stubs. The application process usually takes about 10 to 30 minutes for consumers. Getting your information together beforehand can help you save time during the process. Thanks for taking the time to watch our video series. If you'd like more in-depth explanations of any of the topics covered in this series, head on over to the resources section at LendEDU.com. Student loan refinance is a great option for borrowers looking to better manage their student loans. At LendEDU, we make comparing student loan refinancing lenders easy. With a short 5-minute application, you can compare up to 5 lender quotes so that you know you're getting the best rates and terms available. Head on over to LendEDU.com to get started.